Good morning. My name is Clive Thompson. I've been investing money for 50 odd years in the stock market. I've made a lot of mistakes, but I don't make as many as I used to. I've learned a lot of lessons, and I'm here to share with you how to make money in the stock market. And I'm hoping that by listening to my many lessons on stock market and investing, that you will learn also ways to secure your financial future if stocks are your thing. Yesterday I did a video, it was on the beach, and I talked about what you do if there is a market crash and how to handle that. So surprisingly I got hundreds of comments, I think 300 comments or something like that, and I tried to respond to every single comment, or at least every single question which was asked, but there were some really interesting questions, so I thought I'd go into that and answer some of the questions here directly, even though I did answer in the comments on the YouTube video. One of the comments which I got quite a lot of, people said that the noise of the waves, whilst it was really relaxing and they loved it, they also said it was a little bit too loud. So next time when I go on the beach, I will certainly make sure that I'm a little bit further away from the waves so the sound is quieter, and I'll have a better microphone so you can hear me more clearly in the event that that's difficult. But you know, many people did love the relaxing sound of the waves. They kind of said it soothed their nerves because of the volatility the markets were having at the moment. Anyway, on to questions. So the first question came from somebody called Woof Meow 247. He says, "Hello Clive, hello from Ireland. Your theory of a new digital currency in parallel to the old fiat currency, leaving the debt in the rapidly inflating old system. I haven't heard you mention it for a year now. Have you revised your outlook? It appears to be coming on the horizon now. US crypto digital asset regulations, stablecoins, gold recall, Basel III, BRICS unit, Besant recent Bretton Woods comments, Lagarde, CBDC, October deadline comments. It would be like when the euro came in alongside existing nations' other currencies, which were phased out over a couple of years." And he goes on to say, Simon Hunt put forward a similar theory. He said that he heard from a very well-informed Wall Street insider that there will soon be $2, one for domestic and one for international. So yes, I'm delighted to answer that question. The question really is whether we are going to see some sort of default or currency reset, and whether the method for doing that will be via splitting the currency into two parts, an international part and a domestic part, and that's certainly a possibility. Or, in my opinion, more likely, they'll use the central bank digital currency known as the CBDC, and you're going to hear a lot more about that in the coming months. They'll use the CBDC as a way in which they're going to split the currency into two, and then effectively there'll be a default on one of those. Now, when I say there's going to be a default, it won't be a default, but if you hold the wrong one, you're going to lose your money. Now, that doesn't mean to say you lose your money if you're invested in stocks, and my videos are all about stocks. So those who hold stocks will continue to hold those stocks. They won't lose money. The stocks might go up or down in price. That's a different question, but they'll still be there. If you're holding the wrong type of money, when the reset effectively happens, you'll be stuck and you won't be able to spend that money, and therefore if you can't spend it, it'll be worthless. So let me describe how that's going to happen. And this is not the only way that you lose your money by holding fiat. There's many other ways, one of which is the more popular theory, is we will lose all our buying power over time due to rising inflation and ultimately hyperinflation. And I perhaps would modify that a bit to say that hyperinflation will be occurring in desirable asset prices more than it'll be occurring in things which are made by robots. So let's talk about the central bank digital currency and the old dollar, the old euro, the old pound, the old Swiss franc, the old yen. It is likely that in many countries we will get what's called a central bank digital currency, CBDC, and you, as a member of the public, will find it very convenient to use the CBDC. You'll have a CBDC wallet on your phone, and your bank will probably hold a CBDC wallet on your behalf as well. And you'll be able to spend your money freely and easily with your CBDC wallet. Now, we mustn't forget that this CBDC, whilst it will be interchangeable one for one with the dollars in your bank or the dollars in your pocket, it'll look to all and sundry as if it is exactly the same thing as the dollars you hold today. Just like if you have 100 cents, it's the same as a dollar, and if you have a dollar, it's the same as 100 cents. They're interchangeable. But can you imagine what would happen if suddenly a dollar is only worth 50 cents, for example? Now, which is the real money? Is it the 50 cents or is it the dollar? Well, it depends on the rules. If they say you can spend only dollars, then that's the real money. If they say you can only spend cents, that's the real money. And if you're only getting 50 cents for the dollar, well, you've only got half as much. You've lost half your money. Now, I'm not talking about exactly the same kind of situation, but I want you to imagine that when we talk about CBDC and the US dollar, or CBDC and the euro, or CBDC and the yen, and so on, that's not very different from holding British pounds and euros. They're actually issued by different governments. And let's suppose that the pound was in the European monetary system and therefore interchangeable with the euro at a fixed exchange rate. And don't forget, we did have fixed exchange rates before 1971, where every currency was at a fixed exchange rate to the dollar, and therefore at a fixed exchange rate with it between each other. So it's not without precedent. Now, imagine we were in a fixed exchange rate pounds to dollars, and you could freely change one from the other. And one day they say, well, actually, you can still keep your pounds, but you can only spend euros. So if you want to spend, you have to change your pounds into euros at 1-to-1, and then you can spend them. That's fine. You can keep your pounds in the bank, you can keep your pounds in your pocket, but if you want to spend anything, you have to change over to euros. But there's a restriction. You can only have 20,000 euros in your personal wallet on your phone, and in your bank you can put as much as you like into your CBDC wallet or your euro wallet, provided that it meets certain regulatory requirements as to what you're going to do with it. Now, that's the kind of situation. Then one day you wake up and you find there's a restriction. You're not allowed to move any more of your pounds into euros. Temporary. We'll lift the ban, but too many people are speculating against the euro, and therefore to stop you doing that with your pounds, you can't move your pounds into euros. You can only use your euros in future. Your salary is paid in euros, your taxes are paid in euros, your spending is in euros, everything operates in euros, but your old pounds are left behind. Well, what are old pounds worth if you can't spend them? Nothing. Now, that was obviously a real analogy to help you understand where I'm coming from, but let's assume that we have the central bank digital currency, and I think it will come eventually, and we have the domestic dollar, domestic pound, domestic euro, domestic yen, and so on. And you're freely able to change your money into the central bank digital currency, which is what you have to spend. Initially, you can spend either, but later on they'll make a rule saying for money laundering reasons, anti-money laundering reasons, for tax evasion reasons, for anti-terrorism reasons, we want to make sure we control what people are doing with their money, or at least we can understand it if needed. So you've got to pass by the central bank digital currency, where everything can be known. So we're now using the CBDC. Your salary is paid into your CBDC wallet, your investments are made via your bank's CBDC wallet, and so forth. But you've still got your old pounds, and you've got your old euros and your old dollars. And then one day, there's a bit of a panic, and that the value of, let's say it's the government bond market, is crashing. Could be anything. We don't know what could be happening. So they suddenly bring in a restriction. You can no longer move your old pounds, dollars, euros, yen, whatever it happens to be, into your CBDC wallet, or you're limited to a certain amount, and you can only spend the CBDC wallet from the CBDC wallet, as has been the case already. So now you've got effectively two currencies operating side by side. You've got the old currency, which you're not allowed to spend, and the new currency, the CBDC, which you've got to spend by law. So what's your old currency worth if you can't actually spend it? Because nobody wants to take it off you, because they also won't be able to spend it. Well, in the early stages, you might get some people to take it off you because they think that this restriction is just temporary and it's going to go away, and therefore you might be lucky enough to be able to sell your old pounds at 70 pence on the pound, or your old dollars at 70 cents on the dollar, and you might have a window of opportunity to do that, and 3 months later you might be lucky if you can still get 30 cents on the dollar, and a year later you'll be lucky to get 2 cents on the dollar, and a year after that you won't be able to find anyone to give you anything. So effectively, your old currency, if you had a lot of it, has gone to nothing. Now the man in the street's going to lose nothing, because the man in the street's going to be 100% in the CBDC wallet, 100% in CBDCs. But the big losers will be foreign nations who hold treasury bonds, gilts, bunds, ECB bonds, and so on. They are holding bonds which are going to be repaid in the old currency, which, when they get that repayment, are effectively worthless. Now, as far as the government is concerned, the issuers of these bonds, they're fine, because now they can print money with impunity to pay off these bonds with absolutely no effect on the economy, because you can't actually spend the money that people get in the economy. So no, in answer to your question, woof meow 247, no, I haven't gone off the idea that we're going to have a split in the currency and we're going to have a default through two currencies. But I want to stress, it's not the only way things might play out. There are lots of ways you might lose all your money or all your spending power if you are wealthy enough to have both the CBDC wallet and your ordinary assets. Now, most people will only have the CBDC wallet and they won't care. They'll say, screw that, I don't care that it's foreigners who've lost their money. So if you're in Africa or somewhere like that and you've got a bunch of dollars in the bank account, well, it's not a CBDC, it's bad luck, you've lost it. That's what they'll say. They'll say, oh, it's the rich who've lost it. Obviously, the rich will be very sad that they've lost their money market funds and their bank deposits. But on the other hand, they'll be just fine because they still own their yachts, they still own their houses, they still own their stocks. But if you want to be like them and you have some surplus money and you want to invest it in a way, well, what we're talking about on this channel is investing it in stocks, but you'll find plenty of other places which propose property or gold and silver, and you can know that I go on a channel regularly, the Manica 64 channel, where we talk about gold and silver as a way of preserving our wealth through some sort of currency reset. So long and short of it, if you go into a reset owning cash, you're probably going to be the loser. If we go into a reset and you own something else, something like stocks or gold or property or other tangible assets, you'll still own them when we come out the other side. You don't know what they'll buy, but it's a way of getting from the old system to the new system intact. Okay, let's go on and find some other questions that were asked here. I'm just scrolling through to have a look at them. So Michael here says, great advice, Clive. Personally, I have known how to value stocks, but perhaps stupidly, I didn't make a leap to decide what to do between them. I love your idea of keeping an open target price and rebalance between them. I guess it could work in a crash and also really any time. You're right, Michael. So the idea is you keep a list of all your stocks. Maybe, let's say you've got 10 stocks, you keep a list of each stock and what you think each stock is worth, as well as what the market price is. Now, clearly you're going to think, you wouldn't be holding these stocks unless you think they're worth more than the market price. So you've got a discrepancy between the market price and what you think they're worth. And you also keep a list of stocks which you don't own, but you potentially like to own, let's say another 5 or 10 stocks, And again, in this list, you keep the details of what you think each one's worth and what you think the market price, not what you think, what the market price is, and you regularly review that. Now, the advantage of a crash is that things can become very disorderly. They could, in a crash, I'm just looking at my notes here, there will be opportunities which are thrown up because some stocks will be sold off for reasons other than what people think they're worth. So the efficient market theory, which many people believe in, they think that all stocks reflect the true value of the stock. I don't believe in that, by the way, but many people do. If the efficient market theory does exist, it doesn't exist in a crash because people are forced to sell for all kinds of reasons. People sell for emotional reasons. They ring their banker and they say, sell everything, everything's gonna get a lot worse. So the banker sells everything. He throws out the good stuff with the bad stuff. There are people who get margin calls. They have no choice. The bank said, you borrowed money, your stocks aren't enough to cover what you borrowed. We have no choice. We're going to sell everything for you unless you come up with some cash within 24 hours, or in many cases, the deal is they don't ring you, they just sell anyway. So they're selling the good stocks with the bad ones, and so some good stocks will get pushed down to ridiculous prices for reasons unrelated to their fundamentals. The last reason you'll get stocks going down to irrational prices in some cases is the fact that people will be randomly selling stuff because they think there are opportunities elsewhere. Oh, I've always liked XYZ stock. Where can I raise the cash? Oh, I've got this other stock which is worth a lot. I'll sell it. And it's because it's at a profit. Obviously, it was a good company, so it's at a profit. They'll sell it to buy the other one. Again, it's kind of an irrational situation to go from a really good company to a really good company unless there's enough of a price differential between their different respective values versus market price to justify that. But people behave in very irrational and emotional ways in stock market crashes. And then, of course, you've got the people who are forced sellers, not because they are forced by their bank to sell or because they have excessive emotion, but perhaps they have a liability down the line. They've committed to buy a house and they're planning to pay for it with the stocks that they own, and suddenly they see the stocks deteriorating and they think, well, that was fine, but I better hurry up and sell now rather than wait and see if there's not enough money next week or next month. So again, you could have people selling stocks for irrational reasons. So yeah, that's my answer. Understand what the stock's worth, understand what the price is. So you have a list of your stocks with prices and value. Oh, the lights went off and went on again. Don't know what happened there. A power cut temporarily. I hope the video keeps going. And then you have a list of stocks which you'd like to own with what you think they're worth and what the price is. And in a stock market crash, some of those prices will become extremely mispriced, and that creates the opportunity for you to look at the list of what you own and the list of what you'd like to own and maybe make some switches. Bear in mind, disorderly markets create disorderly prices, so you have to be careful how you trade. I discussed that in the video, so you can see how to do that if we have disorderly prices. Let's look through the okay, here's a question. I haven't answered it yet because it's just come in as I'm writing, as I'm speaking here. It's from Brown Goat 933. Mr. Thompson, so happy to see you have your own channel. Thank you for taking the time to share your financial wisdom. At one point, you made a comment on one of Mario's videos that you're using Python as a stock screener. This inspired me to see if I could do this myself. That's great news. I am no spring chicken, and I'm not a coder. But with some Googling, I found a way to use Claude AI to make a Python program so I could sort stocks using Yahoo data and looking for technical things. I'm comfortable with like MACD and stochastic and Fibonacci. I'm happy with the results. Thank you for your inspiration. Well, okay, let's talk about that. I'm no spring chicken. I'm 68 years old. I retired 3 years ago. And about 6 months ago, I heard someone mention that they were using Python, that's a computer programming language, in connection with stock research. So I asked them how they do it, and they replied, well, happy to show you, but I'm actually a Python teacher, so I've got these lessons organized. If you want to come online and do the lessons, I'm happy to do it. So I did the lessons. I did 8 lessons there. I think it wasn't very expensive. And somehow I got this passion for Python, the computer language. I've never been a coder in my life. I've never been dealing with databases or anything like that. But Python seemed to be the tool to give me access to do all kinds of things which go beyond what you can do in Excel. I won't go into all the details, but one of the things with Python is you've got what's called an API, which allows you to poke into data which is on websites. You can also scrape websites. Scraping means you actually read the entire web page and do something with the data on the web page. But let's talk about APIs quickly. APIs, many websites offer what's called an API, and with Python and with the code for your API, which is a private code, like, a bit like a Bitcoin key if you like, you can use Python to poke into the website, grab that data, bring it out, manipulate it, and do what you want with it. So what you can do, you can write all kinds of programs to do things which you don't find in publicly available tools, and that's what I've done. I'm doing stock screening with Python. It's not the only thing, it's one of many tools I use, but it's great for research. So just very quickly, I've written a tool, I call it Fuggle, Fuggle. And what that does is I put in the name of a stock and it will go and search the entire internet for any period I specify. It will read all the web pages which have got something to say about that stock. It will then combine all those web pages into one giant text and try and summarize it, obviously favoring the web pages which are more reliable and others which are not reliable, and it will finally come up with a very well formatted and designed description about the stock with all the pros and cons. Now that's just one use. There's many other ways I've used Python for stock research, but yeah, it's a great idea. And yes, you can use it for stochastic Fibonacci tools and MACDs and things like that. If you have a lot of time on your hands, go ahead and learn Python. And if you don't, this guy mentions using Claude. I think he said, yeah, Claude AI. That would be Claude Sonnet, I think. I think that's the one, if I've got it right. Yeah, go ahead and ask Claude to write the code for you. Just to explain how easy it is to program these days, you don't have to be a coder. I said to my 8-year-old, I said, go ahead and write me in Python code some code to calculate, or rather to write the Fibonacci sequence. 10 minutes later he came back and said, I've done it. So I go and have a look, and of course he's still got his Claude window open there, and he's basically repeated my question to Claude and cut and pasted the code into Visual Studio, it's Python code, and run it, and it works, of course. You could call it a cheat if you like, but actually it's not a cheat at all. It's the way coding can be done nowadays. Very sorry for all those coders who learned it the hard way, because now there's an easy way. It's a bit like the visual artists, I'm really sorry for them. The people who used to do graphic design, they're really good artists. They spent their life learning how to draw and paint and design, and suddenly we've got all these programs which can do it in seconds. I'm really sorry for you. The world is changing, and the people are losing their jobs because of it. But we've had many technological innovations, and we still have 95% of the population who could get a job if they wanted one. So yeah, if you want to learn Python or use Claude or another program to write the Python for you to do stock research, you'll find lots of ways of doing it. let's move on with a few other questions. Here's a good one. The question is from Gordon KR Bavac 6861. Thank you, Clive. Please explain why I'm selling the stocks close to their original valuations during a crash, please. In my mind, they held their value during a crash, so it must be of real value as deemed by the market. Also, why am I buying stocks that have absolutely fallen quite a bit? Wouldn't the market be a better judge than me and its original valuation? It's almost like selling off good stocks, holding their value, to buy stocks on your original list that have lost value determined by the market, i.e. selling off the good stocks, the strong stocks, to buy the weak and fast dropping stocks. Thank you so much. What a great question, Gordon. So, assuming you've chosen a portfolio of blue chip companies, which are good companies, and you're confident that that's not changed, there's absolutely no reason at all why you need to sell anything in a market crash. Unless, of course, you've got margin calls, you've got no choice. But let's assume you don't. There's no need to sell. You can keep what you've got. And history and statistics show that those who make the most money in stocks are those who have a simple buy and hold strategy, and they hold the stocks through thick and thin. They don't try and trade them, they don't buy and sell. And that's been my experience too. I found that when I look back over time, and I'm talking not recent years, not recent decades, but I'm talking about when I was in my learning phase. Let's call my learning phase the first 18 years of investing in stocks, something like that. But in my learning phase, one of the lessons I learned in the first 18 years was that portfolios I'd held 5 years ago would have done better if I'd not bought and sold things. In other words, I was just stuck with the portfolio. And the realization of that came to me one day. I had a brokerage account, and in the old days, it wasn't like today where everything's online. It was where you spoke to people, spoke to you one-to-one, you traded the stock, and then they'd send you the stock certificate in the post, and you kept the stock certificate at home. And your broker would keep a list of what he thought you owned. But for various reasons, I stopped trading a little bit. And then when I started trading again, I got a new brokerage account with a new broker. I met somebody, and he's not a stockbroker, and for whatever reason, I decided to start trading with him. So what we do, you ring the broker, you place your order to sell something, they would send you a contract note and a stock transfer form. You'd fill in the stock transfer form and send it back with a share certificate. Then they would send you the money, and then when you bought something, you'd place the order by telephone. They would send you a contract note, then you'd send them a check in those days, and you had to send it before the settlement day, and then shortly later, a little bit later, they would send you back the paper stock certificate. So I had this old broker who had a list of the stocks that I had bought through him, so he knew correctly what I owned. And now I had this new broker where I was buying and selling things without telling my old broker that I'd abandoned him. Anyway, some years passed, quite a few years, maybe 5 or 6, maybe 7 years, I don't remember. And I hadn't traded through my old broker, the first one, because I was doing everything through the new broker. Then one day the old broker wrote me a letter, because we did have letters in those days, there was no email or anything. And the letter went something like this: Dear Clive, it's a long time since I've heard from you. I just wanted to give you an update on the value of your stocks. Here's your portfolio. And he sent me a portfolio valuation. And I looked at it, and I couldn't believe my eyes. It was like, I don't know, I think let's call it £500,000 or something. And I thought, God, well, I've only got 20 or 30,000 pounds here invested in the stock market. I couldn't believe it. And I went through this, and I found that some of the stocks I'd sold 7 or 8 years ago were now worth absolute fortunes. They'd gone to the moon, but unfortunately, when they'd gone up 20 or 30 or 40%, I'd sold them, and now they're up 10x, 10 times what I'd paid for them. I would have been a lot better keeping them. So that was a lesson for me, that holding stocks through thick and thin rather than trading them was actually the best strategy. However, obviously, Gordon, you picked up the point that in my video I was talking about what to do in a crash, and I was talking about changing your stock from left to right. So perhaps it's worth explaining a little bit the distinction between the two. So as I said, if you have a blue chip portfolio, there is no need for you to do anything, but there is the possibility for you to look at the relative valuations of your stocks, because things can become disorderly and there might be better opportunities elsewhere, but they're only better opportunities if you know for each stock you'd be interested in buying what the value is and what the market price is, and for each stock you'd be potentially a seller of, what the value is and what the market price is. Now, if you've got relatively good stocks, no need to do any trades, but you might find some opportunities. And so that was kind of what I was trying to explain, that prices can become distorted in a market crash, throwing up opportunities to make switches. But maybe more importantly, if you hold some stocks which don't have those wonderful prospects, in a market crash, you might find some companies with really great prospects whose prices have been beaten down to irrational levels. Well, that's your opportunity to sell the stocks you probably shouldn't be keeping for the stocks you should be owning. I hope that answers your question, Gordon. So, just on finishing off on that, we have something called the efficient market theory. The efficient market theory, which, by the way, I don't really believe in, but a large number of people do. The efficient market theory says that all stocks reflect the true value of that stock at any point in time. I think the evidence that that's not true is the fact that you can have no news, but between two dates, one stock can move up and another one stock can move down when there's no news on either to justify that relative movement. So why are they moving? It's because someone somewhere has to sell. Perhaps there's somebody who's died and they have to pay the death duties, and to pay the death duties, they have to sell the deceased stocks to raise the cash to do that, forcing the price down for reasons completely unrelated to the prospects of the company. So you have an irrational price, one's down, and then maybe another stock has gone up, not because it's a great company, but perhaps that stock happens to be in an exchange traded fund. Let's say there's an exchange traded fund focusing in, solar stocks, and that stock happens to be a solar stock. Well, let's say an institutional investor decides to put a few $1 million into that exchange traded fund. That forces the ETF to buy every stock in the index, pushing up the price of all of them. So the prospects for those solar stocks has not changed, but what has changed is the price. So yes, stocks can reflect things other than the efficient market theory. Of course, over time, if things become overpriced, there will be investors who come in and push the price towards the fair value, but that doesn't necessarily happen in one day, and it certainly doesn't happen in a market crash where things can become very chaotic and it's very difficult for people to quickly know and understand what the best price of a stock should be. Here's an interesting question. Somebody wrote, his name is Tsengsuki 5259. Can someone give me a summary? I don't have time to listen to 35 minutes right now. Okay, so someone else replied actually and said, proper bookkeeping and research. Take the time to be methodical about your investing and saving. That's part of what my answer was. The other answer I said was, keep that list of stocks. Your stocks, comparing market price with the stock market price, and what you think it's worth, so your target price plus stock market price, and keep a list of stocks you don't own, maybe another 5 or 10, where you have a target price and you have the stock market price. And in the event that prices start to move around very rapidly, compare one list with the other, and you'll find your opportunities to buy and sell. So that's your quick summary for those who don't have 35 minutes to listen to the full thing, view the full story. And let's see what other questions we got. Somebody was asking me about the connection between the sea and feng shui and stocks. Yeah, they're all peaceful in a certain sense, but I don't think I've got the... Okay, here's a question from Sodai Goku 12 hours ago. He says, if you invested in an index fund ETF is exchange traded fund, it's a fund which holds all the stocks in an index. If you invested in an index fund ETF from your income each month, would it make sense to increase your dollar amount as it moves down and decrease it as it moves back up? So you're talking about modifying the the system which is known as dollar cost averaging. There's a well-known system called dollar cost averaging, which says if you put an equal amount into the stock market every month, and we assume the stock market goes up and down all the time, the theory says that by putting an equal amount into the stock market over time, every month, for example, you will have an average buying price which is lower than the average price seen during the period of investing. And that's because when stocks are down, your money buys you more of those stocks than when stocks are up. If you want to test it, just do yourself a little chart with an up-down price and buy it at monthly intervals. You'll find that that is mathematically true. But the modified approach, which is being asked at here by Sodai Goku, is what if when stocks are down, you increase your monthly payments, your monthly investments, and when the stocks are up, you decrease them. All I can say is that's a really great idea. If you've got extra income and you can afford to do that in the bad months, it's a wonderful idea to invest more when stocks are low and maybe then go back to a normal investing level when stocks seem to be higher. The difficulty is what happens if stocks go up and 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 up forever. Then you keep reducing the amount you invest, and of course you never get the chance to invest. You've got more and more cash building up waiting for that dip, which maybe never comes. So it can work. I think it's a great idea if you've got cash spare, surplus cash, surplus income. Yes, it's a great idea to put more money into the stock market when it's down, if you can, but there's a limit to how long you wait for that. So if stocks are just going up in a straight line, you probably want to be still investing, but you don't buy the index when stocks are high. You look inside the index to find those stocks which are the best value and offer the best growth. And I've done some other videos about that, and I'll be doing many more. Okay, we've probably got time for one or two more questions. Here's somebody concerned about the whole banking system going bust before he pays for a house that he's got to pay for. That's a tricky one. I think your safest bet is put it in a money market fund while you're waiting to pay, because you don't want to risk the stocks going up or down, and you don't want to risk the bank defaulting on you. Let's just have a quick look. Okay, there's a question here, it's a bit of a long one. Clive, I very much enjoyed this walk along the shore. This is coming from Blaine's Tube. Thank you, Blaine's Tube, for your question. This type of keep your head talk is sorely needed in the time we live in. The shame is that it will fall on so many deaf ears. Look, I'm glad you're listening, and I hope I can improve your financial future with my experience of 50 years of investing in stocks. He says, I've seen so many interviews you've done, but this beach walk and talk has triggered me to subscribe to your channel. Thank you, and if you want to subscribe, please do so. I look forward to watching your stroll with your son recently. 2 things I'd love to hear you address. True underlying value. 1, I understand many sectors aren't valued in the same way, but is there a shorthand method you use to determine true underlying value? I'm afraid our options are to get a degree in fundamental stock analysis. Good, that's answered your own question, at least part of it. Or just to gauge a stock by book value. Well, there are great investors who did exactly that and made it work for them. And then he asked me about a particular stock, which I won't comment on that one, I'm afraid, because I don't really want to give investment advice in terms of specific stocks. But here's my answer. There's no universal way of determining value because there's many different methodologies. So every investor uses his own methodology or methodologies. I try to use them all, There's some great investors in the world that have all got their ways of valuing stocks. I try to use different ones at different times, but all of them are good ways. And of course, book value is one way. The earnings per share, multiplying it by a multiple is another. So you've got to take into account growth. So a fast-growing company, you might want to take the earnings per share and multiply it by 25, and a slow-growing company, you might want to take the earnings per share and multiply it by 10 to get to a fair value. You've got to look at sustainability of those earnings per share. Some people value it on dividends. They say, I want to get a 3.5% dividend or a 5% dividend, and they will only value stocks based on their dividends. That's not really a good way to value stocks, but if your priority is to get a certain level of income, it's not wrong, provided you look at the sustainability of that income and the growth in that income. Anyway, let's just go on and say, how can I make it easy for you? If you don't want to get a degree in stock analysis and fundamental analysis, there are many websites out there which will give you their analysis of the stocks, depending on how sophisticated you are and how much you want to spend on it. But there are many free sites. So first of all, on a lot of free websites like Yahoo Finance and others, you can find what's called a target price and maybe some commentary on what the stock is worth. I give you 2 sites. I'm not promoting these, I just happen to use them a lot, which I like. The one for beginners, which gives you a snapshot in a microsecond, is called simplywall.st, Simply Wall Street, but it's the code is simplywall.st. You can, at a snapshot, see if a company is good or bad by looking at what they call it. It's called a snowflake, but look at it. If it's all green, that's really good. And if it's all red, that's not so good. But another one I like is Market Screener. I go to that, marketscreener.com. That also gives you target prices. By the way, both of those give you target prices. And there's a section which tells you all the good things and bad things about each company. So if you don't want to spend too much time looking into it and rely on other people's research, those are 2 websites which give you a lot of information, as does Yahoo Finance, which is absolutely free. By the way, all those websites I mentioned, they do have a free version. I'm using the paid version because I probably want stuff that you don't want and don't need, but you'll get what you're looking for in the free version, I think. And maybe one last question before I switch off here. I'm 44 minutes into this video. Let's jump to this one. This is one of many. Let's see. Oh yeah, really good one here. A lot of replies from other people. So this is from Armandorise 2750. I have a question for you, Clive, and I hope that you have an answer. I don't know what the percentage is, but let's just take the USA. What can people who don't hold gold, silver, or any kind of portfolio do? Many Americans don't have $100 in their pocket, let alone $1,000 in the bank account. Yep, good point. First of all, I'll just read some of the other comments before mine. So this guy replied, fishing gear, seeds for a garden, hunting tools, dried beans, rice in mylar bags with oxygen absorbers, water filtration, sterilization, and storage. Great. Let me just give you my response, and I perhaps will read it to you here rather than say it blind. So I wrote, sadly, this is exactly the kind of situation with millions of people around the world, America included, and many of these people are deeply in debt. There is no chance of ever getting out for many of them. And unfortunately, there's nothing I can suggest which will help some of those people. It's like when you go to see the doctor and you say, I've got cancer, or you see the doctor, he says, well, you've got terminal cancer. And you say, well, what can I do? And the doctor says, well, you've got 3 months, there's nothing I can do. There are situations where I can't help. I can help some people, but I can't help everybody. So let's go on. But there are some people who can help themselves if they make the right move. It's much easier to do that if you are young. It's much harder if you're older and stuck in your ways and you've reached a certain age. So when I was young, and especially after I started living away from my parents, what did I do? I had 2 jobs, one in the day and one in the night. And I couldn't afford a television because you had to pay a television license fee of £50. I didn't eat meat to save money. I was more on rice and peas and beans and things like that. What else did I do? I obviously had no telephone, because those were the days when you had the telephone on the table, not a mobile phone. We're talking about 1970s here, late 70s, early 80s. I had no telephone because that cost money. I didn't go to the pub, I didn't go to the discos, I didn't go out, I didn't eat out, never ate out, couldn't afford it. So I had these 2 jobs, I had income coming in. Eventually I had enough money to put down a deposit on a small 1-bedroom flat. But despite it only having 1 bedroom, I managed to move in a lodger. I won't go into more details on that, but the lodger helped pay the rent. And yes, the other thing I did was I studied for my exams. I studied like crazy every second of every day, on the train to work, on the train back, in my lunch hour and my tea breaks. I really studied really, really hard until I passed the initial 13 exams I needed for what was called the Institute of Bankers diploma. By then I knew what I was talking about, and when you know what you're talking about, you're more valuable to potential employers. So I could change jobs and get pay rises when I changed jobs, and obviously we had a little bit more inflation then, so the pay rises were perhaps higher in changed jobs than you can get today. But as a young person, I could do that. But I had to put up with some inconveniences, like having a lodger and so forth. But despite these inconveniences, it allowed me to spend less than I was earning, and because of spending less than I was earning, I had surplus income which I could invest in the payments later on for a mortgage, and earlier on in investments in the stock market. That's when I was making my very first stock market investments. I had a few punches on the nose back then, but they weren't punches on the nose which caused me any harm, because firstly I had it was surplus income that I was investing, and I hadn't borrowed any money at the time, so it's a way of surviving. But sadly, there's a lot of people who won't have those opportunities I just described, and I'm really sorry for that, because perhaps they're later in life, or maybe they're very young and they've had a baby, and when you've got a child, it's very hard to have two jobs and study, and of course you've got that extra expense of the child. So yeah, I'm really sorry for you. I can't do anything for you. These are situations where I can't help, but there will be some of you who have the opportunity to start early, and if you make that sacrifice, you will have that extra income to invest, or you might be one of the lucky few who are born rich, part of the 1% of the society who are born into wealth. And yeah, someone wrote a reply here. Thank you for your response. The only reason, this is the original asker. He said, the only reason I ask is because, and let's see if I can get this right, the top 1% owns the majority of the wealth and stock market, and only 10% of Americans stack silver and gold, and 40% or more don't have $1,000 in their bank account. In most futuristic movies, you see the poor walled off from the rich. Yeah, sadly, you sound like you're so right. All I can say to you is do what you can to get ahead of the game. It does require sacrifices, it does require hard work and effort, and you could only do that if the opportunity is available to you in the first place. The reality is we do, and really sorry to say that, we don't live in a communist world where everybody is equal and everyone has the same thing. I'm not saying that's a good thing or a bad thing, because communism, we all know, does not work. It's only capitalism where people have the possibility to make more by making extra effort, which has produced the wealthy world we're in today. Of course, not just people working hard, but also thanks to the governments borrowing money, printing it, distributing it, and to keep the population of the world fed. But of course, that money sooner or later gravitates up to that 1% who are the super rich, who are creating the products that we all like to use. I mean, let's face it, everybody in Africa is walking around with a mobile phone, and I'm really pleased that they got that, but those mobile phones wouldn't exist if it weren't for the wealth creators having the motivation to want to invent something which is better and available to the masses in the first place. So let's just say, well, I'll try and do one very last question. There's many questions I haven't answered here, but I have answered them all in the comments. Let's just scroll through these questions here. 4 replies. Nope, not that one. Somebody says I remind him of his granddad. Thank you for the compliment. I actually just became a granddad a few days ago, so that's really nice of you to say. But I also have an 8-year-old, so not that old either. I'm 68. Let's see, this is a question here, I think. Okay. Thank you so much, Clive. This is from Silver Machine 7. I really appreciate your videos and for sharing your extensive knowledge. This is probably a very basic question for you, but it is one I struggle with. When you refer to cash, where are the best places to park money right now? At the moment, I'm treating gold, ETFs, as exchange-traded funds, etc., as a place to park some cash, as bonds seem to be a minefield, with currency fluctuating so much. Any ideas would be greatly appreciated. He also asks if I could walk a little bit higher up on the beach next time. I don't know if that's because the sound of the waves were too loud or whether you would like to see the ladies in the bikinis, but I think that's a great idea. So, best place to park cash. I think if you need the cash and you need it in cash, I think the best place to do it is a money market fund, as you don't necessarily want to take the risk of a single financial institution. And you're quite right. Putting your money into government bonds, you're putting the money into the hands of a government who has zero chance of ever repaying that. The only way they can repay you is by borrowing from Peter to pay Paul. That will work for a while, but there will come a day when they can't borrow from Peter, and that's when there's a crisis, and they bring in all sorts of new rules which will not work in favour of those who've got money in government bonds or other fiat assets. Of course, if it's in a money market fund, it's invested to some extent in government bonds anyway, but the alternative is to put it in the bank, and if there's a crisis you might not get any of it back. At least with the money market fund you might be able to get something back in a real serious financial crisis. But the trick, as you say, is to invest in other things, and that does include gold and silver. It does include physical gold and silver, where you can buy some coins and keep them. Now that's the sort of stuff you don't buy and sell, you don't buy to trade, you buy to keep forever, just in case the worst happens and you need to spend it. Now we might do that, we might have to have that situation, some sort of crisis, but you can also save in the stock market, but you have to accept that there'll be large fluctuations from time to time. So, obviously there's two tricks. One, to buy gradually, so you're buying both when stocks are high and low, so that if you have to sell when stocks are high or low, or when stocks are low, at least you bought some of them at a low price in the first place. But hopefully, if you're just saving money, invest in tangible assets of any kind, and that could include real estate. Now, there's real estate where you invest in the bricks and mortar, which don't move, and that's very illiquid. Or there's real estate investment trusts, REIT, real estate investment trusts. They are funds which are quoted in the stock market, which invest in bricks and mortar, and that's the way of getting in. And I think that's 56 minutes, coming up for the hour mark, so I'm going to stop now. If you like my videos, please give them a like, give them a thumbs up, and if you subscribe, I'd be really grateful. I've got nothing to sell, I've got no product to sell, no services to sell. I don't give investment advice. Nothing in this video is supposed to be investment advice. You have to do your own research on everything. But obviously if you've got a question, I'll be happy to answer it and help you see if your thought process is going in the right direction, or help guide you to go in the right direction, obviously without investment advice. So thumbs up and subscribe. Thank you very much, and I really appreciate. Oh, by the way, I want to say, in the last video I did, there were so many lovely comments. It's the lovely comments like yours that you're giving me which encourage me to share my knowledge and my information with others, with free of charge, and I'm very pleased that you can benefit from it, and I hope that it will help you improve your financial future. I think you have to do that if you can, because I think it's going to be a big mistake for those who think the government's going to look after them. There'll come a point when the government can't look after you. It'll be a very serious situation globally, and I hope that it doesn't come in my lifetime or your lifetime, but I fear it will. So my suggestion is try and look after your own financial future. Thanks very much. Thumbs up, subscribe. Bye-bye.